Good morning, students. We'll continue with the 11th Standard Economics, Chapter 6. In that next topic is profit. In this topic, we can study the 4 types of profit theories given by the various economists. First, we'll see what is the meaning of a profit. Profit means the entrepreneur, the business owner, after meeting all his expenses, that means after paying all his expenses for the land, labor, capital, what is left over, the remaining amount, that is called as a profit. There are 3 kinds of profit. First one is a monopoly profit. Monopoly profit means the business owner himself control the business on his own control, whatever the profit is making, that is called as a monopoly profit. Second one is a windfall profit. Windfall profit means sudden changes in the market. As we said, the touch phone to button phone to touch phone, the sudden change in the market, no? So that if anything changes in the market, if you are gaining the profit, so that is called as a windfall profit. Unforeseen profit, unexpectedly you are getting a profit, that is called as a windfall profit. The third one is a profit of a functional reward. For example, other than that, if you have a asset building, means apart that your own building, the rent is given by others, that also can be considered as a profit. The interest whatever you kept in the bank, for the amount what you kept in the bank, for that the interest as given by the banker or any other person is giving the interest, and that also can be considered as a profit. Next is a concept of profit. In that first one is a gross profit. What is the meaning of gross profit? Means after minusing, reducing, subtracting all your expenditure to manufacture a pencil or a fridge, how much the expense you are making. For example, if you are making the expense of 3,000 rupees and you are selling it for 5,000 rupees, so you are minusing, subtracting all your expenses, what is left there, that is called your profit. So that's what the gross profit, the formula for this gross profit is total revenue minus total cost. Total revenue means total income what you are getting after meeting all your expenses. Next is a net profit or a pure profit or economic profit or a true profit. That means net profit means after meeting all your expenses, truly after meeting all your expenses, self-owned resources. For example, to manufacture a pencil or a fridge means suppose you have to transport facility also all should be, you have to deliver your goods to a customer, means the transport what you are using, it may be yours, your own. That means entrepreneurs his own property or his own resources. Suppose அந்த vehicle வேற யாருக்கிட்ட இருந்து வாங்க, if you are doing means you have to pay the charge for that, but you are using your own thing, your own resources you are using, so it doesn't mean that you should not pay the charge for that. If you are using own resources, you have to pay for it because the calculation has to be done. So if you are using your own resources also, the payment should be made for that. So that's what the pure profit, meeting all the expense, that's what that is called the implicit cost they are telling. So meeting all your implicit cost, what is left over, that is called as a net profit. The formula for the net profit is gross profit minus the implicit cost. Next is a normal profit. Usually expecting, if I manufacture a fridge means I can get a profit of 5,000 rupees, means that is normal. If your expenditure, your cost is manufacture a fridge is 10,000 rupees, only your expenses manufacture after meeting all your raw material things, materials, payment to the laborers, transport, after meeting all your expenses, you can sell the fridge for 10,000 rupees, means the extra profit is maybe you got a profit of 3,000 rupees. That is expected. You are expecting இதுதான் வரும் அப்படின்னு previously you predicted. That is called as a normal profit. Supernormal profit means unexpectedly. That means you thought that for me I manufacture all this fridge, I'll get a 3,000. Unexpectedly, after seeing your fridge color or your features of your whatever you added technology, means the customer will be happy, or they wanted to pay more. Then after seeing all this, you increase the price of your fridge of 10,000 to 15,000. So unexpectedly you are getting 5,000 extra, means that is called as a supernormal profit. So the formula for this, actual profit minus a normal profit. Next will come that there are 4 types of theories for the profit. First we'll go for the dynamic. You can see the dynamic theory, innovation theory, risk bearing theory, and the uncertainty bearing theory. In that we'll go for the dynamic. It was given by the J.B. Clark in the year 1900. So according to him, dynamic theory means the profit or a price. The profit is how you will get the whatever the product you are using, that should be sold in the market according how much the price will be fixed for your product. According to the price only the profit will come. So according to the economist J.B. Clark, what he is telling, the profit will be determined according to the dynamic change in the society. The reward for profit will be dynamic change in the society. If there is no change in the society, means you cannot, suppose the society whatever we are living, if there is no change, if it's stagnant, means your profit also will be stagnant. That's what you wanted to tell is, if your society is changing, the dynamic changes in the society, means your profit also will be increases. If it's stagnant, means your profit also will be stagnant. So, and also further he explains, changes are permanent. Tamil solla maacham ondre maaradhu, adhe mari changes are permanent. So what he was telling, further he wanted to explain, first what can be, means first the population will be increases. Suppose the population increase, means you will automatically produce more product. If you produce more product, means the profit also will be increasing. Next one is the capital increasing. Keep on, if you want to produce a more product, means you have to buy the more capital or raw material, machine you have to buy. Next is the method of production, means the technology you have to improve yourself to the modern world. Next, the industrial organization change. That's in small scale industry, large scale. If you are converting your industry into large scale, that time the profit increases. Then the consumer is eager to buy many products. Usually consumers wants are multiplying. They wants are multiplying, keep on increasing. So according to that, if you produce, means you will get a profit. That's what the dynamic theory says. The economics J.B. Clark says. And the next theory was innovation theory. So according to this theory was given by the Joseph Schumpeter. So according to him, the entrepreneur, the owner, business owner is not only the undertaker of a business. That means undertaker is not a starter of a business. He should also be the inventor. Producing new, thinking of a new innovation. So the reward, whatever the profit you are making, that is a reward for your innovation. So according to him, some points he was consists innovation, what the innovation should consist of. First one, a new product, as we said that button phone to touch phone, newly the technology what we are using, innovating has been in the market. Like that, the innovation should be there. Second one, the new method of production should be there. Not usually, as usual, what we are using, and newly technology according to meet the previously you see what is the dressing style of previous last generation. Now one can see the now new generation how their dressing sense will be there, fashion will be there. According to the new technology, fashion, the product should be there. Next is a new method of production. Next, new market. That means if your industry is domestically, if you are inside the country only you are doing, means go for a wider international market, launch in the an international. That means opening for a new market. Next, discovery of a new raw material. Suppose you are producing a soap, means how I can give a new flavor of a soap, neem, aloe vera, or I can go better than that for a herbal product, not adding the chemical product. That new variety of a raw material I can make it. So that should be discover yourself. The company has to, research has to be made, and you have giving a new product, means that time you can have a profit. Next, reorganizing industry. That means you can make the branches or from internationally or inside the country, many places, giving job opportunity to all the many people. Previously 1,000 people, means now we are going to give a 10,000 people. Reorganize technologically and manpowerly you are using, means that time you can earn a more profit. So according to him, to this theory, what he wanted to say means, if you want continuous profit, means you have to innovate more. Continuously you have to innovate. New technology you have to innovate. Then only you will have a continuous profit. Next is a risk-bearing theory of a profit. So usually this was given by the F.B. Harvey in the year 1907. So according to him, actually business means risk only. So if you are taking more risk, means you will get a more profit. So if you are able to take a higher risk, means your profit also will be higher. So according to him, so what he wanted to say is that if you predict the future, you can say the good example of a touch phone and button phone. So what the button phones manufacturer of Nokia company, what they thought that they did not predict any other company can launch a new innovation or technology can adopt. They did not predict it. That's why they started manufacturing without the prediction. They started manufacturing more cell phones and kept as a stock. That's why they become a loss for the business. So if your prediction is correct, means you can get a more profit. Your prediction did not incorrect, means you get a loss. இப்போ அடுத்து நான் லான்ச் பண்ணுற ப்ராடக்ட் இது இவ்வளோ ப்ராஃபிட்டை கொடுக்கும் அப்படின்னு முன்னாடி நீ திங்க் பண்ணி வச்சுக்கணும். இப்போது டச் ஃபோன், இப்போ நான் வந்து புதுசு டச் ஃபோன் இஃப் ஐ எம் மேக்கிங் ஐ எம் தி செல் இன் த மார்க்கெட், மீன்ஸ் இது வந்து நிறைய ப்ராஃபிட் கொடுக்கும் அப்படின்னு நான் ப்ரிடிக்ட் பண்ணதுனால the company, the Apple company, manufacturer of, they get the more profit. The Nokia company, they did not predict, and வேற ஒருத்தர் நியூவா ஒரு டெக்னாலஜி அடாப்ட் பண்ணலாம் மார்க்கெட்ல அப்படின்னு he did not predict. That's why you get a loss. That's why if your prediction is correct, you'll get a more profit. If your prediction is incorrect, you get a loss. That's what the risk bearing theory of a profit. Next is the uncertainty bearing theory of a profit. So this was given by the H. Knight. This uncertainty, the profit can be the difference between insurable and non-insurable. Insurable means what? Means you'll expect it. You'll previously you measure and keep. That means fire accidents if it's happen, or a theft if it happens, natural disasters happen, means what you'll do, you'll keep the insurance, or insurance company will keep the premium, will be made the monthly, you'll keep. So you know that what will happen previously, you'll predict in the previously and know, and you make the payment. Insurance you will make for all the missions or persons or your company you're keeping. That is the insurable risk. If anything happened also, you'll have a risk. You don't have a risk. The money will be coming from the insurance company. That is called as the insurance risk. Non-insurance risk means suddenly if it's anything happens, unexpectedly, if anything cannot be anticipated, cannot be predicted, anticipated cannot be. That the example, you can market condition, government policies. Last a few years back a VAT was a tax policy, now a GST. So like that, the sudden changes of a government policies, also technology, button phone to touch phone, CD to the pen drive, what you know, that sudden changes, the technology also can be the a risk. uh, that also can be the you can make a more profit or a less profit. So if you are capable to face or guard the uncertain of insurance risk, and the insurance and the uncertain condition, if you are able to face, a business owner is able to face, means to take that burden of uncertain events, means you will get a remuneration. That remuneration is called as a profit. So these are all about the profit and the end of your 6th lesson. Thank you.